SoFi is down 11% over the last few days. It's absolutely insane. Massive overreaction. I'm going to talk about it. I'm going to let you know why it's down 11%. If I believe this is an amazing buying opportunity on a growth stock like SoFi, or maybe it's warranted. Maybe SoFi will really go to $8 per share, like a lot of analysts are expecting. And I'm going to give you my opinion, fair value, main different things, and give you a lot of ideas at the end of the videos related to options and different kind of stuff if you're interested. So I really hope you enjoy this one. My last video on SoFi was at $6.92, so I owe you guys an update. It was a hated stock back then. People were making fun of it, trashing on the company. They're gonna trash about it again now when the stock goes down. But then when the stock goes back up, no one says anything. That's what happens in the market, and that's investing, And I've been very interested in the company. It's been performing very well. A lot of you guys are familiar with SoFi. They're riding the massive digitalization trend of banking in general. They're disrupting a billion, I would say $1 trillion kind of industry that hasn't been disrupted in decades. And especially amongst young people, a lot of them love SoFi because they can go on the SoFi app. They have a high yield savings account. They have an investment account. They have their student loan account. They have their personal loan account, home loan account, anything they want around banking, loans, whatever. It's all in one app, SoFi. They don't have to go to Chase and then go to bank, and they can go all. They just do it on SoFi. They love it. So this is a beautiful thing about SoFi. And I use SoFi for a few things, and I had a good experience. So they have a lot of different products. And members, they've been rapidly growing with SoFi, 35% year on year. And they're not actually 9.4 million members. The recent data is 10 million members. 10 million members. And this is a 9x in less than 5 years. This is massive, massive. I'm very impressed with the company. I wasn't expecting that. And this is why I love the business model so much of SoFi, HIMS, and those kind of companies. Because once they advertise to the customer and they bring them in the SoFi ecosystem, let's say they come into SoFi because they have some money on the side and they want to get a high yield on it within a high yield savings account, okay? And they have a high yield savings account, and then SoFi can advertise to them for free because they're in the ecosystem right now. Maybe an investment account, and then they buy stocks on the investment account. Maybe they're interested in buying a house, then they can advertising them to home loan program, or maybe the student loan program, or some kind of other program. And this is how those companies get more profitable. This is exactly what happened to SoFi. They were losing 484 million. This year, they made 214 million, and they're GAAP profitable. Beautiful. This is why I love those companies. They could just cross-sell to the different kind of the same customer over and over. They only advertise to them once. Once they bring them into the ecosystem, this is all you need to have. And it's just a beautiful business model. Adjusted EBITDA has been expanding. Revenue has been expanding. Everything's been getting better. And there's something that has impressed me very much with the company. And I'm not a banking expert, but I know a few basic things about banking. And normally, whenever interest rates go up, their interest income tends to go up, but the origination fees tend to go down. Because normally, whenever you have higher interest rates, interest income of a lot of banks, they tend to go up. But the demand for loans, especially personal loans, home loans, because we have higher interest rates, a lot of people cannot afford them. So a lot of the origination fees tend to go down. This is why you have companies like Upstart, they've been suffering because Upstart depends on origination fees. They're the middleman, they depend on Credit Karma and other kind of scams, or I should say scams, but other kind of companies, and that's why they've been suffering now, because the demand for loans have been going down. But there's something that has impressed me very much with SoFi. Not only is their total interest income has been actually going up, but their origination volume has been going up as well. It's up 23% despite us having higher interest rates. And this is because of how fast and how rapid the company has been growing. Their home loans, despite us having a challenging housing market, is up 38%. Personal loans is up 26%. I'm very surprised, guys. So that gives me a little bit more confidence going into the future, is if the Fed lowers interest rates more and people, they start pulling their money out of those high yield savings accounts, and maybe SoFi the interest income starts going down, maybe some of the origination fees will kick in and offset a lot of the loss in their interest income. So that gives me a little bit more confident to be kind of more bullish on the stock going into 2025 and into 2026. And I was very impressed looking at guidance. Guidance has been very impressive. Original guidance for 2024 was 7 cents per share. Then it went to 10 cents. Now it's 12 cents. This is more than an 80% upward revision. And this is a company that's well known for aiming low and beating on guidance. And this is more than an 80% revision. Beautiful. So the question is, if SoFi is such an amazing company, and if everything has been improving, why is the stock going down 11%? What's happening? Well, there's an analyst from KBW, which I read about this firm on X, and they don't have the best reputations. They have a reputation of, downgrading good companies so they can do some trades about them, and they don't have the best reputation. But they downgraded the stock to $8 per share and to underperform. And they said the stock is overvalued, the valuation is overstretched, it's trading at 69 times expected earnings for 2025, while the median consumer digital lender is 12.2 times. And to me, this is a funny comparison, because this is like you're comparing some kind of a TV company, old school TV channel company to Netflix. Or it's like you're comparing an old school radio station company to Spotify. I mean, you cannot make those comparisons. Like that. I don't. Maybe they're comparing it to Capital One or like Synchrony Bank or something. I don't really know what they're trying to compare it to. But are those consumer digital lenders that are trading at 12 times? Are they growing users, or I should say, are they growing members 9x in less than 5 years? I highly doubt it. Are they growing earnings per share? 136% gap in 2024, 112% in 2025, and potentially 67% in 2026? I don't think so. SoFi is trading less than a 1 PEG ratio, less than a 1 price to earnings growth, almost at a half price to earnings growth at 64 or 65 times expected earnings. So it's not as expensive as this analyst is talking about. And I think he's just trying to get the stock to go down. I mean, that's the way I look at it. And I agree with a lot of people that said the same thing on X. A lot of people said the same thing, and I kind of agree with them, because it's not a fair comparison to make, comparing SoFi to the old school lenders that have little to no growth, and they don't have growing users. They have users leaving them because they're too complicated to use, and they're using SoFi because they only have one app, and they get any kind of digital needs, any kind of lending needs, banking needs, all in one app. So, and they have a bright future too. So again, I'm not saying why it should be going down that much, and I'm not saying what this analyst is talking about, but he does have a point, to be honest, that in the near term, the valuation has gotten a little bit overstretched, and the stock has been straight up for over 6 months. It deserves to go down a little bit. It deserves a break. Nothing goes up straight forever, except Palantir and Tesla for now, and a few other stocks. But yeah, I mean, he has a little point in the short term. But I'm gonna give you a fair valuation model over the next 5 years and a few other things. And I'm gonna use some estimates. And the main argument I always get whenever I do those estimates and give you my fair value on the growth stocks in the comments is people will go and say, especially value investors, they would tell me, you always say a lot of ifs. There's a lot of ifs in the video. What if this happens? What if that happens? Of course, there will be a lot of ifs. When you're valuing a growth stock, it's all about the future. It's not about the present. This is not Coca-Cola. You're not going to value this stock on last 12 months free cash flow. You're not going to value this stock on trailing earnings. This is all about the future because it's an early stage of the business cycle. So it's all speculative. SoFi is a speculative stock. It's not, something I would put in my entire net worth into. What I do with growth stocks, I put in a small percentage. If they work out, they go up 10, 20, 50, 100 times. I don't need to put in much of them to make money. If they don't work out, I don't lose much. That's what I do. But if I look in at the, as actual versus consensus, and this is pretty much the actual revenue of SoFi on a quarterly basis versus the analyst estimates, they pretty much beat every single quarter since SoFi has gone public. As you can see in the blue, SoFi has beaten the estimates every single quarter. Now, because they have beaten the estimates every single quarter, we can kind of claim that they will likely beat them again in 2025. We cannot be sure, but we can kind of say that there's a very high likelihood that they will do it again in 2025. Therefore, I'm going to use the 2025 EPS estimate of 28 cents gap for my model, and I'm going to put it in this calculation. It's like a compounded interest rate calculation, very simple stuff. And I only value stocks over the next 5 years because that's what I do. 3 to 5 years, I try to aim for it double. If I can at least double my money in 5 years, then then I know I'm paying a fair price, and then I just leave them for the long term. This is what I do. I just focus 5 years, and then I just leave them alone. So I took the 28 cents for 2025, then I put it for 4 years after that, and the growth right now is for 2025 112%. A lot of you guys will say this is too high, but the company just turned profitable. So if net income margin goes from 1 to 2%, this is 100% growth. It's not as high as it sounds. But then the analysts are expecting 67% and 32%. I'm not banking on 67%. I'm just taking it from 112% all the way down to 30% for 4 years. I think this is more achievable. And if I put it in, I'm getting 80 cents per share in 2029, which is 5 years from now. If I get 80 cents per share gap, okay, and this is 80 cents per share, and using SOFI right now is trading around 64 times earnings. Now I'm going to take the multiple in half. From 64 times, I'm going to say that SOFI is going to trade at 35 times. I think if the company 5 years from now is growing around 20-25% earnings per share, or 15 to 20%, if it trades twice the growth, this is around 35 times. I think 35 times earnings for something like SOFI, which I think they will likely grow 15-20% EPS or revenues for many years to come, as a lot of people are moving a lot of things online. I wouldn't say 35 times earnings is too expensive. Now, if I time it by 35 times earnings for SOFI, this is around $28 per share. If I divide it by the current price of $14, this is around a double. So a 2x or 100% upside over the next 5 years. Now, if I can get it double with SOFI, assuming a 50% multiple contraction and assuming a 30% growth instead of 67% growth for the analyst, and they've been beating the analysts, they haven't been missing them, I would say SOFI right now is not a bad buying opportunity. It's a very good deal. Even over the next 5 years, I see a 15% per year return or a double over the next 5 years. It's not bad at all. So I would say SOFI is a good buying opportunity at this price. It's not the best buying opportunity. I would say it's a good buying opportunity. Now I'm going to say one more thing before I get into my idea in terms of an option trade that would let you buy SOFI at $8.50. And this is the argument that if SOFI is such a great company, then why are the insiders selling so much stock? This is the same question I get when I talk about HIMS, I talk about any growth stock. If this is such a good company, then why is the insiders, they keep selling stock? It doesn't make any sense. The main reason why they sell, and the CEO has been buying, by the way, but this is back in May. The main reason why they sell a lot of stock is because of stock-based compensation. A lot of those tech kind of companies, they issue a lot of stock. Because they issue a lot of stock, they have to, take the stock-based compensation as a salary. So they have to sell them. If you go back to Palantir, the insiders have been selling the stock since it was like $4 or $6 or something crazy. Same thing with HIMS. They've been selling it since it was $7. Same thing with SOFI. It doesn't mean they're bearish. It doesn't mean they're expecting a crash. It just means they're taking their stock-based compensation. So it doesn't mean too much with a lot of the tech companies. And this is something you have to pay attention to. Now, for me personally, I don't own SOFI. I own other growth stocks. I don't own SOFI yet. But I've been selling put options on the stock before, and I'm going to do it again. And this is exactly what I'm looking at with SOFI. If SOFI keeps going down, I'm very interested in selling the $10 put option on SOFI. Now, if I sell the $10 put option on SOFI, I would have to lock in around $1,000 for every single put option. Now, if you're new to options, you could maybe watch an options basic video, but I'm going to try to explain it to you very quickly. Okay, now this is a January 2026 $10 put on SOFI. Okay, if you're selling this $10 put option, okay, you're gonna collect $147 on your $1,000. Now this is around 14% return. So on your $1,000 that you're locking in, you're gonna collect a 14.7% yield on this $1,000 no matter what. If you get assigned or if you don't get assigned. If SOFI goes up from here and it stays above $10 for the entirety of 2025, you're not gonna have to buy SOFI and you keep your $147 or your 14% return. It's a free 14%. You got your 14% for 2025, easy money. You don't have to do anything, okay? Now, if SOFI goes below $10 per share by January 2026, you're gonna have to buy at least 100 shares of SOFI by this time. And if you do buy SOFI at $10 per share, you would pay $1,000, but you would have already collected your premium, if you remember, which was $147 per share. So for your for your 100 shares, you would have only paid $853. Okay. Now you divide $853 by your 100 shares, you would have only paid $8.53. So instead of buying SOFI for $10, you would buy 100 shares of SOFI at an adjusted cost basis of $8.53. So for me personally, this is an amazing risk-reward setup where worst case scenario, I get to own SOFI at $8.53. Best case scenario, I don't have to own SOFI and I collect at least a 14-15% yield on my cash and I just leave it alone and I collect my 14-15%, and this is a good risk reward bet. So if SOFI keeps going down, that's what I'm trying to do and that's what I'm looking at it. And if you want to learn more about options, you could check out my own group. I teach that stuff and I do a lot of that things if you're interested. And that was just my opinion on SOFI, not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.